It's 11:47 at night. Marcus is lying in bed, staring at his phone. He's not scrolling. He's not watching anything. He's doing math in his head. If the car payment clears tomorrow before his direct deposit hits, he's overdrawn. Again. That's $35 he doesn't have for a mistake that lasted 48 hours. He's not irresponsible. He's not lazy. He makes decent money. He just has nothing left after everything goes out. And somewhere across town, in a glass building full of people Marcus will never meet, someone is very happy about that. This video is about why your bank needs you exactly where Marcus is. Why financial stress isn't just an accident of circumstance. It's a feature of a system that was designed to keep you there. And why the moment you cross one specific number, that system stops working on you entirely. That number is $20,000. Not because it makes you rich, not because it solves everything, but because of what it does to the machine that's been running quietly in the background of your financial life, whether you knew it was there or not. Here's something your bank has never told you directly. They have a score for you. Not your credit score, a different one. An internal profitability score. A number that tells them exactly how much money they make from you every year. And depending on where you land on that score, they treat you very differently. Most people have no idea this exists. By the end of this video, you will. And once you understand it, the way you see every bank offer, every credit card ad, every overdraft notification, all of it changes. Let's go back to Marcus for a second. Last year, Marcus paid his bank $340 in overdraft fees. He didn't budget for it. Nobody does. It just happened. A few bad weeks, a few bad timing decisions, and suddenly he's paid nearly $400 for the privilege of being temporarily broke. He also carried a credit card balance for 9 months. At 24% interest, that cost him around $480 in interest charges. He paid a $12 monthly maintenance fee on his checking account 4 times before he hit the minimum balance requirement and it stopped. Add it up. Marcus sent his bank over $860 last year in fees and interest. He got nothing back for it. No product, no service, just the cost of being in a tight financial spot at the wrong moments. This is what the financial industry quietly calls the poverty premium. The less money you have, the more everything costs. Overdraft fees hit hardest on accounts with the lowest balances. The highest interest rates go to people with the least options. The fees that get waived for customers with larger deposits get collected in full from everyone else. One study found that the bottom 15% of earners pay 27% of all financial service fees in this country, over $110 billion a year, extracted from the people who can least afford it. It's not a glitch in the system, it's the system. Now here's where the internal scoring comes in. A large-scale analysis of over 70,000 bank customers found something that should make you stop and think. Nearly half of all bank customers, 48%, generate zero profit for their bank. Some actually cost the bank money, but the top 1.56% of customers generate 50% of all profits. So who are these golden customers the bank loves most? They're not wealthy people with large savings accounts. Wealthy people don't pay overdraft fees. They don't carry credit card balances. They don't need high-interest personal loans. The most profitable customers are people who are perpetually almost okay. People who earn enough to keep their accounts open, but not enough to avoid the fees. People who need credit but can't qualify for the best rates. People who intend to pay their balance in full, but don't quite manage it every month. Here's the math on what that means in practice. A customer who overdrafts regularly generates around $700 per year in profit for their bank. A customer who never overdrafts generates around $57. That's 12 times the value. For credit cards, a customer who carries a balance generates roughly $240 a year. A customer who pays in full every month generates about $25. So when Marcus generates $860 in fees and interest, he's not a struggling customer the bank feels bad about. He's a highly profitable customer the bank quietly depends on. This is why your bank sent you that overdraft protection offer. It's why they keep raising your credit limit when you didn't ask. It's why the app is designed to make spending feel effortless and saving feel like a chore. It's not customer service, it's customer management. Now let's say Marcus does something different this year. He gets serious. He cuts 2 subscriptions, picks up a few extra shifts, redirects his tax refund instead of spending it. Slowly, painfully, over about 2 years, he builds his savings up to $20,000. And something strange happens. His bank stops making money from him. No overdrafts. He has a buffer. The timing panics are gone. No credit card interest. With savings behind him, he pays the full balance every month without stress. No maintenance fees. His balance clears the minimum comfortably. No desperation borrowing. When his car needs repairs, he transfers from savings instead of putting it on a card at 24%. Marcus went from generating $860 a year in profit to generating almost nothing. From the bank's perspective, he's gone from a premium customer to a problem. The industry even has a term for customers like this. They call them deadbeats. Not because they don't pay, the opposite. Because they pay in full, on time, every time, and give the bank nothing to extract. The credit card industry literally distinguishes between 2 types of customers: revolvers, people who carry balances and pay interest, and transactors, people who pay in full and pay nothing extra. Revolvers generate 72% of all credit card interest revenue. Transactors generate 0.7%, not 7.7. When Marcus crosses $20,000, he becomes a transactor. He becomes a deadbeat in the most honorable sense of the word. He also becomes largely invisible on the profitability score. And invisible to the extraction machine is exactly where you want to be. But here's what the financial videos don't usually talk about. The change isn't just in the numbers. Something shifts in how Marcus thinks. Below $20,000, his brain was running a program in the background, constantly, every waking hour. It was calculating, checking, worrying. Can I afford this? What if something breaks? What if I get sick? What if I lose shifts next month? Researchers call this scarcity mindset. And it's not just an emotional state. It literally reduces cognitive bandwidth. One study found that financial anxiety consumes the equivalent of about 13 IQ points of mental processing. You're not less smart when you're broke. You're just spending a massive amount of mental energy on survival calculations that people with savings don't have to run. With $20,000 in savings, Marcus's car breaks down, and his first thought is annoying, not catastrophic. His landlord raises the rent, and he has time to make a calm decision instead of a desperate one. His boss treats him poorly, and for the first time, he can genuinely consider leaving because he has months of runway to find something better. The $20,000 doesn't just protect him financially, it gives him his mind back. That mental freedom is what the scarcity system was always trying to prevent. Because calm people make better decisions. And people who make better decisions are very hard to profit from. Now here's the part most people never see coming. The moment Marcus hits $20,000 and looks financially stable, something changes. But not in the way you'd expect. The system doesn't leave him alone. It comes back harder. His bank sends a premium card offer. Metal finish, higher limit, a fee that's only a few hundred a year. His investment app unlocks advanced features, margin trading, leveraged options, products he doesn't understand yet. His credit pre-approvals jump from 4 figures to 5. His social media feed fills with people his age renovating apartments and flying business class. And some part of his brain whispers, "You've earned this." This is the moment the system pivots its strategy. When you're broke, banks profit from your desperation. When you look stable, they profit from your ambition. A new car that costs $745 a month over 5 years. At that payment, you're sending nearly $45,000 out the door, and new cars lose roughly 20% of their value in the first year alone. A premium credit card with rewards that feel like a win, but carry a rate of 24 to 25% the moment you carry a balance. An actively managed investment fund with an expense ratio of 0.65% versus a simple index fund at 0.05%. That difference seems tiny until you realize it compounds for decades. On a $20,000 investment, you're paying roughly $130 a year instead of $10, just for the fund someone selected for you. None of this feels like a trap. That's what makes it effective. It feels like graduation. It feels like finally getting to live, and the system is very, very good at making it feel that way. So Marcus has fought his way to $20,000. He's escaped the extraction machine. Now the machine is rebranding itself as a reward. How does he protect what he built without living like he's still broke? Here's the mental model that changes everything. 3 layers. Layer 1 is the floor. This is the number Marcus never goes below. His bare minimum monthly costs, rent, food, utilities, transport, multiplied by 3 to 6 months. For most people, that lands somewhere between $15,000 and $25,000. This is not a savings goal. It is a line in the ground. It doesn't go down except for genuine emergencies. Not flash sales, not flights, not because he's bored with his phone. The floor is the foundation every future decision stands on. Layer 2 is growth. Everything above the floor that isn't earmarked for immediate life. This goes into simple, boring, low-cost investments, index funds with low expense ratios, retirement accounts, things that work quietly in the background while Marcus lives his life. The math here is slow and then suddenly isn't. At $2,000 invested and 8% annual returns, you earn $160. At $20,000, that same return is $2,000. Same person, same job, same contribution, completely different trajectory, because the base is finally big enough to matter. Layer 3 is options. This is the fun layer. Trips, upgrades, experiences, career pivots, helping someone you love. The things that make life feel like life and not just financial management. The rule is simple. Layers 2 and 3 can move around depending on priorities, but they never reach into layer 1. The floor stays the floor. This is what separates the people who hit $20,000 and keep climbing from the people who hit $20,000 and find themselves back at $6,000 18 months later, wondering what happened. Marcus used to treat $20,000 like a destination. Now he treats it like the ground beneath his feet. There's something nobody says out loud about building savings when most of the people around you aren't. It's lonely sometimes. Your friends are going on the trip. Your co-workers are talking about the new car. Someone you follow online just renovated their kitchen and made it look effortless. And you're packing your lunch and watching a number slowly climb. You're not depriving yourself because you have to. You're choosing to. And that distinction is invisible to everyone except you. That quiet discipline, the months of saying not yet, the redirected tax refund, the side gig hours. That's not a small thing. That is you refusing to be the product. That is you removing yourself from a system that depends on your stress to function. And the day that number clears $20,000, something shifts that has nothing to do with what you can now afford. You realize you've been playing defense for years, reacting, surviving, managing, and for the first time, you can play offense. Here's what $20,000 saved actually means in plain terms. It means your bank's most profitable tools stop working on you. Overdraft fees, gone. You have a buffer. Credit card interest, gone. You pay in full. Desperation borrowing, gone. You have options. The anxiety math running in the background of your brain. Quieter. Not silent, but quieter. It means when your employer treats you badly, you have months of runway to find something better instead of having to absorb it. It means when a real opportunity appears, a career pivot, a move to a better city, a chance to take a calculated risk, you can actually consider it instead of immediately calculating why you can't afford to. The average American has less than $1,000 in savings. 78% live paycheck to paycheck. Those statistics represent hundreds of billions of dollars in annual bank profit. Overdraft fees, interest charges, penalty rates, desperation products. The entire machine runs on people never reaching $20,000. And every dollar you add to that floor is a dollar the machine can't reach. Let's bring it together. Banks have an internal profitability score for every customer. Most profitable, people who are just stable enough to keep their accounts open but not stable enough to avoid fees and interest. The poverty premium is real. The less you have, the more everything costs, by design. $20,000 is the threshold where you cross from profitable customer to deadbeat, in the best possible sense. But hitting $20,000 is also when the system changes tactics, from profiting off your desperation to profiting off your ambition. The traps just look different. The protection is the 3-layer model. Floor, the line you don't cross. Growth, quiet, boring, compounding. Options, the life you're actually building toward. And the hardest part isn't the math. It's building in silence while the world tells you to spend. If something in this video landed, share it with one person who needs to hear it, not to lecture them, just because most people were never given the second half of this story. What actually happens after you hit the number, and how not to let the system take it back. Drop a comment and tell me where you are right now. 0, halfway there, already past it. No judgment either way. I read them all. One last thing. Once you've protected the floor and you've got money sitting in that growth layer, the real question becomes, where does it actually go? Not in theory, practically. What does a boring, low-cost investment actually look like? And how do you set it up if you've never done it before? That's the next video. I'll see you there.